The benefits of a conventional mortgage, pros and cons. If you're interested in buying a home and using a home loan, you may be wondering which loan type is best for you. Well, that depends on your personal situation. Working with an experienced lender will help you determine which loan is best. However, it's always a good idea to educate yourself before making a major life decision. So today, I'm going to be sharing the benefits of a conventional conforming mortgage. I'll review both the pros and the cons. Pros of a conventional conforming loan. First, down payment as low as 3% down. This is a big deal. I hear all kinds of myths out there that if you're obtaining a conventional conforming loan that you have to put 20% down. No, not necessarily. So there are 3% down conventional loans available. You'll want to be sure that you're talking with an experienced mortgage advisor. They can listen and look at your scenario and give you guidance on whether you're eligible for a 3% down payment conventional loan, but just know the program does exist. All right, the second pro with a conventional conforming loan is mortgage insurance. Now, even though you can do as low as 3% down potentially, just know once you actually do 20% down and you're obtaining a conventional loan, you will not have to pay private mortgage insurance, or also known as PMI. So 20% down, no PMI, no mortgage insurance is required. If you're putting less than 20% down on a conventional conforming loan, the great news is that there's a variety of ways that you can pay your PMI or mortgage insurance. It can be paid monthly as part of your payment. It can potentially be financed into your loan. So one of those kind of scenarios that really doesn't get talked about a lot is if you're tight on your payment, like your payment goal is a number, and let's say that instead of paying your mortgage insurance monthly, it may make sense to actually finance the cost of the mortgage insurance into the loan. That may reduce your monthly payment. Again, this is where working with a mortgage advisor that focuses on strategy is really going to be helpful to you, because it's not just kind of a one or done, you pay mortgage insurance, let's move on. What we try to do is really listen and understand our client's particular goals and scenario, and then we can show the difference between paying mortgage insurance monthly or buying it out and financing it into the loan. So mortgage insurance on a conventional loan has lots of different ways that actually can be paid, and a lot of people don't know that. And on that mortgage insurance or PMI note, on a conventional conforming loan, the mortgage insurance at some point is automatically going to fall off during the life of the loan. And there are some situations where it can actually come off sooner than where it's naturally set to drop off. For example, if you've done a large principal reduction and now you have 20% equity in your home, you can always reach back out to your servicer and request that the mortgage insurance be removed. If you've done extensive home improvements or remodeling, that scenario works as well. And maybe you're just in a market where your home is now appreciated so much that you have 20 or 25% equity. At that point, you'll want to reach out to your servicer and get their guidelines on how long you have to be in the loan before you can request to have mortgage insurance removed. So not black or white on that scenario, lots of different scenarios within the PMI cancellation process, but just know your servicer or your lender will be your best bet for getting the guidance on how to cancel mortgage insurance if you currently have it. All right, one of the other pros, and this is a big one, is that a conventional conforming loan can be used for different types of occupancy, meaning that if you're purchasing a home to live in, we're going to call that a primary residence. If you're going to purchase a home as a vacation home, then that's a second home or secondary residence. And if you're going to purchase the home and not live in it, your goal is to rent it out, that's an investment property. A conventional loan can be used for all three of those types of scenarios. And lastly, higher loan limits when compared to some other loan programs. So conventional conforming loans, the loan limit is set nationwide for the whole year. So generally that comes out right around this time of the year, so towards the end of the year, and it will be set for the following year. Just know that it tends to be higher when compared to an FHA loan. And secondly, there are some high cost areas around the country that conventional national loan limit could even be higher in some of these high cost areas, such as New York, California, some parts of Colorado, etc. So now for the cons. Conventional loans are very credit score driven, which means that if you have a lower credit score and you're not putting 20% down, not only the interest rate could be higher, but the cost of the mortgage insurance could be higher. Or if you are putting 20% down, you potentially will have a higher interest rate and or costs just based on credit scores. So conventional loans are very, very focused on credit scores. And remember, that's going to be the middle credit score between the three major credit bureaus. And that credit score is going to be what the lender's pulling, not what you might see online when you're checking your own score. Not only are conventional loans very credit score driven, but the guidelines are much more restrictive, especially after bankruptcies, foreclosures, short sales, just life happening. They're much more difficult to get into and the waiting periods can be longer. So again, credit is a really, really big deal when it comes to conventional loans. Conventional loans also are more restrictive on debt to income ratios when compared to other government-backed type of loans such as FHA or VA. So stricter debt to income ratios are absolutely something that we have to be focusing on when we're talking with a client about a conventional loan. And if you want to learn more about how to calculate a debt to income ratio from a lender's perspective, be sure to check out my video on calculating debt to income ratios. All right, another con, if you will, on a conventional loan could be that you might have to have additional monies just held in reserves in addition to your down payment and closing costs due when you're acquiring a home and using a home loan. And so again, these are not monies you would have to liquidate, but from a lending standpoint, sometimes depending on the program, you will be required just to have some additional monies in what we call reserves. So that could be 1 or 2 months of your total house payment, including HOA. If you own a lot of different properties, it could be reserves for each house that you own. So reserves are going to vary, and it's not easy to say, yes, you need it, no, you don't. It's one of those that it's really based on every individual's unique scenario. So now you know the pros and cons of a conventional mortgage. Please do me a favor and subscribe to this channel for more valuable mortgage education. I want to make sure that you make an informed buying decision. So be sure to subscribe and become part of our community. If you got value out of today's video, please like it, give us a thumbs up, and don't forget to share. See you next time.